Would love to hear a little bit more about kind of your, perspective on, where we're at now, and what does the prudent investor do in the type of, commercial real estate cycle that we're in today.
I think this might be a bit controversial, but I think fundamentally when you're investing in real estate, the game plan is to always be patient.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. I'm glad you're here. Now let's dig in.
All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into yet another episode of the Freedom Point. We're so glad you're here with us again today. I've got another amazing guest, as I always do, Mustafa Ladha. Welcome to the show.
Hey, Jeremy. Thanks for having me.
Yeah, absolutely. I'm really looking forward to chopping it up with you today. Madha retired from his 9-to-5 in the pharmaceutical industry at, get this, the age of 29. He attributes this to his passion to learn and grow and build financial freedom. And his motto is, you know what? If he can do it, so can you. So Mustafa, when I was in my early ages, okay, so we're talking about like junior high, senior high, I always told myself, and I told others around me, that I'm going to retire by the time I'm 50. Okay. Well, I technically made that dream become a reality just this past year, but I was 45. In your case, 29. So I've got to have you let our listening audience know, of course, a little bit more about Mustafa, your journey, what you're focused on today, etc.
No, more than happy to. I think fundamentally, Jeremy, you and I are probably of a similar mindset in the sense that like we might communicate to ourselves or to other people that, hey, I'm going to retire at 50. And then we might, change that goal to whatever it is. But then really that retirement phase is really where life starts to get, maybe a bit more fun in the sense that the goal wasn't to not work. The goal was actually to, at least for me, and I'm sure for you as well, to really implement change and really understand how we can give back to society. And part of that is you can't give back to society if you don't have a stable foundation. And for me, that's really been the cornerstone of my journey and my growth is to say, hey, fundamentally, how can I help people? And how do people need the most help? And that was a journey that took me from, medical school where I was thinking, okay, I'll become a doctor to help people, to working in corporate America. I was at Pfizer, so a big pharmaceutical company, doing drug safety, drug development, to understanding that, hey, people fundamentally don't really have an understanding of their finances. So how do we really help people increase their financial literacy, but really help people on their terms? So it was really just a journey of self-discovery for me, Jeremy, to kind of summarize, that led me to where I am today, if that makes sense.
Yeah, it totally does. And I think you're spot on. It's not, the goal isn't to not work, right? Really for you and for others that are on kind of a similar path or journey, really it's about, what type of impact freedom or philanthropic freedom or time freedom or location freedom, right? It's not necessarily freedom from income specifically. It's more freedom around, how can I replace the dependence on the corporate paycheck and really focus on things that I want to do, and having that freedom to be able to do that and truly, like you say, make a meaningful impact in the lives of others. So I'd love for you, Mustafa, to tell our listening audience a little bit more about kind of what was that tipping point that made you confident, okay, that you could walk away from a corporate paycheck and kind of rip that Band-Aid off.
It's a very good question, because from my perspective, I waited a year too long. So it's one of those things that I think when you have a corporate job and you have all the different benefits and you've seen growth and you're in a position of authority where people look up to you and all these different things, you feel good about yourself, which is great. Everyone needs to feel good about themselves. But the problem is that no one's telling you that you have golden handcuffs. Whether you're making, $50K and feeling good about yourself and you have a nice title and whatever, or you're making $500K and you have a bad title or whatever, you still are married to your job. You don't have that location freedom that we were talking about, that you alluded to. You don't have a lot of other freedoms that honestly I think people would love to be in a position to have. And that's really what goes into, financial independence and financial freedom, is being able to literally do whatever you want, and then really fine tuning that to say, okay, how do I create value? So for me, it was a situation where when I was 29, I had a young kid, I had another one on the way, and it was very easy to make a decision to delay another year and to stay in my job and not quit. Um, that would have been a very comfortable decision to make. But when I was faced with that same decision a year prior, I said, okay, hey, fine, I have a young kid, and maybe it makes sense to wait another year. It's a more risk averse approach. The problem with that is that I'm very much of the mindset that you have to be uncomfortable to be growing, right? If everything is comfortable, everything is easy, that means you're coasting and you're kind of stagnating. Meanwhile, everyone else is learning and growing, so you're actually digressing. You're not actually improving your situation. So for me, it became a situation where I was assessing my life to that point, kind of saying, hey, I can wait another year. But the risk of doing that is that I'll always be waiting another year. I'll always not be taking action, and I'll always be delaying it because I'm in a comfortable position. I have, a six-figure job. I have a six-figure real estate business. I'm doing well by all metrics. But what is the opportunity cost of continuing to work for somebody else in that pharmaceutical job? It means that I can't grow my own business as exponentially. And so ultimately, it was around Christmas time. I gave my, 2 weeks notice. I went on, like, my brother was getting married. My brother-in-law was getting married, went to both weddings, came back, and, basically was, retired from my 9 to 5 job. In that first month, let's say, January, I made more than I would have made the whole year in the pharmaceutical job. And for me, it was just fundamentally that I had more time to think and to really strategize and to really implement and grow. And so that's, it's not necessarily what I expected to happen. And it was very kind of, I think you alluded to it, it was very nervous, or I had to pull the plug. It was, there's a lot of uncertainty in that decision, and it does carry risk. And I was aware of that, but I was kind of also aware of the fact that if I grow too complacent, then I'll never take action and I'll never scale. And I think for some entrepreneurs, you hit that point where you're doing well and you're saying, hey, what's the point of doing more work? What's the point of continuing to scale? That's a really privileged position to be in, because you can say, hey, I'm happy where I am, or I want to continue to grow and I want to continue to improve and I want to get to that next level.
Mustafa, you just gave our listening audience a master class here, so I want to unpack a few things that you mentioned, and I love the fact that you highlight that one of the main reasons why a lot of people have this hesitancy to escape the corporate paycheck and become an entrepreneur, whether that's in franchising or starting up their own business, or maybe just ripping off that Band-Aid, is really because a lot of people are chasing after the next title, right? Which is just a name, right? Behind their name. They're, of course, comfortable with the stability of having benefits, right? But the truth be told is that you can get your benefits yourself, and it's not going to really cost you all that much more to be independent. People, of course, are chasing after the consistency of a paycheck, and some are just chasing after the recognition and the allure, right? And if they've got a scenario where they're structured on a performance-based pay program, or maybe they're just chasing after the next carrot, and once they get that carrot, there's always going to be another one that trails it. And I really like the discussion that we had, or you had, around becoming a daily better version of yourself. You talk about things like operating in an uncomfortable state, taking action. What's the opportunity cost, of sticking with a corporate W-2 job versus, scratching the entrepreneurial itch. And really this concept of, now your mission is to fulfill your own dreams versus the dreams of a corporate entity, if that makes sense.
Yeah, exactly. I think you hit the nail on the head there, Jeremy.
Good. Well, I know that you've used the phrase client-centered investing before, and it sounds like a nice buzzword, right? Can you break that down for us, and what does it really mean in practice?
Yeah, sure. I think great question, Jeremy. Very, very simply, I think when you're in the space of like the personal finance space or financial services, I think a lot of the conversations can be really opaque and confusing. And I'm of the opinion that it's kind of by design to confuse people. So for me, it's fundamentally to understand what does the person actually want? Because like you mentioned, it might be franchising, it might be something outside of real estate. Fundamentally, if they want freedom, how do you actually qualify what freedom means for them? Because it's different for everybody. I mean, you mentioned a couple different things, whether it's time, location, etc. So ultimately, when I'm talking to a prospective client, it's really to understand how do they want to make money, and based on that answer, there's maybe different strategies that are better. Then when you take it from a different angle or a different approach, you say, okay, hey, fundamentally this investor has a very low risk tolerance, so they don't feel comfortable taking risk. Why would I want to structure something that has a higher risk tolerance? Or why would I want to structure something where they have to invest cash? They can invest their retirement capital, for example. Now, if they're investing their retirement capital, that was money that was illiquid until 65. They couldn't access that money until 65 anyway, and they probably weren't going to. So it's to say, hey, let's pivot the conversation. You don't have to invest, your savings. You can keep that as savings because you're telling me that you have a high, a low tolerance. You don't feel comfortable taking risk. So I don't want you to feel like you're losing money or taking money out of your pocket. You recently changed jobs. You can access your 401k. You don't know how that was performing anyway. So let's talk about that. Let's see, first of all, maybe I'm wrong. Maybe you do know how that's performing. But let's see how it's held up versus the stock market, because that's what you're essentially investing in. Has it met, exceeded, or is your performance much lower? For most people, their 401ks are not performing well. Don't realize that because maybe it's like Transamerica and they have like a sunny, like that you have a bright future when you retire. So they've taken like your whole financial picture and reduced it to an image, which is fine because it feels good and it helps you feel like you're on track. But then the question is to say, fundamentally, if you could be on track sooner, or if you could have more money in retirement, would you want that? And for most people, the answer is yes. So Jeremy, like I just gave you like one specific profile of a person, but I think when I say client centric, it is, I guess, a buzzword, which I have a huge disdain for. But fundamentally, it's just to say that you're actively listening to the person you're speaking to really understand what they're saying, and then to really listen out for what they're not saying, and to clarify like what are the layers and the subtext behind what you're not saying, because this might be an avenue worth exploring. Because for a person like you or a person like me, we spend all of our time learning about how money works. What that means is we probably have access to strategies that people don't know about because people are busy working in their profession, becoming an expert in that. So that's really, when I talk about having a client centric approach, that's really what I refer to, Jeremy.
Yeah, no, that makes sense. And I appreciate you unpacking that. And obviously, it absolutely comes down to each investor's individual goals. The challenge is not a lot of people have identified what those goals are. And of course, you and I both know that they do change over time. My investing goals in my 20s are very different than the investing goals and strategies that I now have in my 40s, right? And the other challenge, that folks face out there is there's also a lot of noise. There's a lot of institutions that are jockeying and positioning themselves for your money, right? And so I think it's really important that people understand, the human element of investing. So I'd like for you to unpack, what the human element to investing is, and how does this really shape the way that you approach, different investment opportunities.
I think, Jeremy, some of this stuff can be a bit taboo. Some of it can be a bit uncomfortable. Some of it can insult people unintentionally. And it's unintentional. It's not the point of the conversation. But the point of the conversation is to really unpack what you said, to understand people's bias. Like fundamentally, if I invest with Jeremy, if I invest with Mustafa and Jeremy would make money in that situation, ideally. Okay, how do they make money? Just like today, if I have a financial advisor and I'm pulling out my money from this brokerage to invest in real estate outside the brokerage, there's almost no situation where the brokerage would recommend that. Like in my experience, I have had situations where they're less against it, but they'll never recommend it while saying real estate is a good option, but now is not the right time, is typically the phrase and the terminology that people would refer to and people would mention. But if you look at REITs, which are publicly traded real estate trusts, those have historically performed better than the stock market in terms of like the equities market. So if you were to ask your financial advisor, okay, if not real estate, private real estate outside of the stock market, if not now, then when? And so that's one of the things that is important to kind of unpack, at least from my perspective, Jeremy, when you ask the question, it's to understand people's bias, because that financial advisor is doing their job. They're advising you, and they're advising you to the best of their ability per se. But the skeptic in the room, or me, as you know, one of the biggest skeptics would say, yeah, but if you pull money out of your financial advisor and he's compensated based on AUM, assets under management, how much of your money he manages. Now, if he manages less money, he makes less. Why would someone intentionally give you advice that hurts them? They're a fiduciary. That's what they're supposed to do. They're supposed to have your best interest in mind. I am not a fiduciary. Jeremy, I don't know about you. I don't think you're a fiduciary as well. Legally, I do not have your best interest in mind. And I'm very comfortable saying that. And I'm very comfortable disclosing how I make money, how you make money. In my structures, you make money first. So I only get paid once you made your money back. So that's like a preferred waterfall that's maybe abnormal in the space. That's not the case of your financial advisor. If your stock goes down, he still makes money. If your stock goes up, he still makes money. If you look at the compounded cost of your financial advisor managing your portfolio, which you can do yourself with Robinhood for free, it's pretty expensive. So it's to fundamentally say there isn't a right or wrong answer with how you manage your capital and how you manage your money, but it's to say fundamentally everyone has bias, and you kind of want to unpack the cost associated with listening to somebody's advice or feedback or perspective, right? Like people can call me up, message me. I'm not charging them for my time, whether they invest or don't invest. Ultimately, when they do invest, or if they do invest, I only make money based on performance. That's not how financial advisors are set up. And that's not to say that there's anything right or wrong about that industry or the one you're working with, et cetera. Everyone is a great person. It's just important to understand the bias, because if I'm going to my financial advisor asking him to analyze a real estate transaction and he's never invested in real estate and his net worth is less than mine, I'm positioning him as an expert on money, but he has less money than me. If he has less money than me, I would argue he's created less value for society than me. So why have I positioned him as an expert on money? Because he has a piece of paper and a job title. Great. And it's not, meant to kind of be rude or anything. It's meant to kind of be a bit scientific about it and say fundamentally this person manages money as their day job for a living. That's their professional experience. He cannot explain me these concepts at a 5th grade level. That means that he doesn't know the concepts well enough.
Mustafa, those were some absolute golden nuggets there. I do, for those that have read my book, The Fundamental Investor, I dedicate an entire chapter regarding the financial advisor community. And I'm a little bit rough, right? I remember, penning in my book, about a lot of financial advisors out there today, are such because they took a test and passed a background check, right? But a lot of those financial advisors out there today, again, they're commissioned based salespeople. They have a performance based pay, model, and their primary objective is to get individual investors to invest in Wall Street investments, right? And what you and I encourage investors to consider is investing in Main Street, okay, not Wall Street. So private versus public, right? And then when it comes to investing in Main Street, do you do it actively as a small business entrepreneur or an active, fix and flipper in real estate, right? Or do you choose to do it, passively? And I think you're spot on. You're highlighting something that, is a bit of a challenge, for folks like you and I that are encouraging people to consider investing outside of the stock market, right? And that is, we're really kind of up against, some massive institutions out there that spend millions, if not billions of dollars per year, advertising to control, public perception to a certain degree, right? And so I really just appreciate your thoughts there. Anything else that you'd like to share in that regard?
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investors. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
Right. And so I really just appreciate your thoughts there. Anything else that you'd like to share in that regard?
No, I think you summarized it quite nicely. So unfortunately, I haven't read your book yet, right? And I say yet because I think it's on the list. But fundamentally, I think you hit the nail on the head. It's like I'll give you maybe an example that may or may not resonate. When I was getting married, I'm not an expert at all in jewelry. So I looked into it. I was like, oh, everyone buys diamond. This makes no sense to me. Diamond isn't even rare. It's just like a marketing strategy and a marketing ploy. So I was like, yeah, this is not for me. It doesn't resonate. I'm going to go and buy Tanzanite. My family is from Tanzania. Tanzanite is only mined in one place in the world, in Tanzania. It's super rare. It's blue typically. It looks nice. I like it. So I'm going to buy my wife a Tanzanite ring. And some of the feedback from like other people was like, oh, why didn't you buy diamond? Why would I buy diamond? It's not rare. But the marketing is so efficient, and the supply and demand and the control of the supply is so strategic that they create a fake story. And I think fundamentally, when you're talking about financial advisors and the industry, I think from one perspective, we are up against a narrative that you have to invest in the stock market to make money. But I think for people like you and I, we've done the research, so we kind of know where the holes are and the gaps in the logic are. And so for me, at least, when I look at it, I don't even view it as like a David and Goliath situation. I view it as fundamentally, when you're investing in the stock market, you can't call up VOO, you can't call up Vanguard. They're not going to answer your questions. They're not going to tell you what their projections are. You can't hold them accountable every month, depending on the strategy. You can't hold them accountable every 3 years, depending on the strategy. You can't hold them accountable every 5 years. You can't say, hey, why didn't you refinance this year? Values are there. Yeah, but we have low interest rate debt. Why would we give that up? Might as well wait a year or two. We'll still refinance. We'll make even more money. Here's a projection if we refinance in 2 years from now. And then 2 years from now, we can talk about that projection. We can talk about that email. You can't do that when Trump, it's March 20th, 2025 when we're recording this. And Trump has a lot of different tariff policies. One day it's active, one day it's not active. One day the market's down a lot, one day it's up. It's one of those things that for the average investor, who's like, let's say, that Main Street type person investing in Wall Street, we don't realize how little information we have. So if we have no information and we're investing in the stock market, and you're probably investing in the stock market, so am I, it's just about having the right strategy, which in my opinion is a dollar cost average. You buy every day, you don't check it, and it's for my kids. Like, assuming they mess up in life and they don't make it at all, it's for my kids. Ideally, they're self-sufficient and they don't need it, but it's like a very, 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 like, of the many different safety nets, it's at the bottom. To say, hey, all these other things need to not work, and then you have your stock portfolio. But I think most people don't approach it like that because of the media, because of the marketing, because of the positioning. But it's to fundamentally say, like, if you're accessible to your clients, if you have a client-centric approach, if people know, like, and trust you, and if you actually put their needs ahead of your own in every conversation all the time, then it doesn't matter if they invest today or not, because your goal wasn't for them to invest. Your goal was just financial literacy. Your goal was just to help them. And then tomorrow, could be 6 years from now, could be a decade from now, you and I will still be around, we'll still be doing real estate, because it's that type of market. They might come in and they might invest more. And that's kind of been my experience, whether it was guys who invested early and made a lot, or guys who waited on the sidelines and saw their friends all making money and then invested later. The guys who invested later typically start out with higher numbers because they've seen proof of concept of their friends investing. So I think it's one of those things, Jeremy, that is a bit different than the stock market. And if the goal is always to compete with the stock market, you're facing an uphill battle to some degree, because of the marketing, because of the positioning, because of like the brainwashing, respectfully. So it's just to say fundamentally, listen, how do you want to make money? Because right now, your stock portfolio is probably more risky. It's harder for you to actually analyze and underwrite each individual stock. The expense ratios are pretty expensive when you actually look at the long-term cost to hold these assets. So it's really just about hitting people where they are, if that makes sense, Jeremy.
Yeah, it totally does. And I appreciate you unpacking that. I'd like to maybe dial down a little bit more on the commercial real estate side, get your kind of perception on, where we're at now, where we're going to go next. But before I do that, I wanted to give you a couple of examples. So, I remember back during the global financial crisis, right? Back in 07, 08, 09. And I remember reaching out to my financial advisor to say, hey, what should we do? And he literally told me, Jeremy, I'm hiding under my desk. Well, that was the day that I divorced my financial advisor and decided to start taking control of my own financial future and learning different ways to invest, smarter, right? Second to that, I remember, back in 2021, where there was a lot of euphoria happening in the commercial real estate space. Everybody was flooding into the market. It was easy to raise capital. Valuations were high, right? Well, I can tell you right now that those investments that I made at the peak of the last real estate market are not going to outperform the investments that I've been making in 2023, 24, and now in 25, because valuations are down, right? So it's the typical buy low, sell high. The challenge is we don't always know where we're at, in the current market cycle, whether it's in the public equities or private equities like real estate. So would love to hear a little bit more about kind of your, perspective on, where we're at now, and what does the prudent investor do in the type of, commercial real estate cycle that we're in today.
I think this might be a bit controversial, but I think fundamentally when you're investing in real estate, the game plan is to always be patient. And if you're in the capital raising space, or if you're in a syndication, or if you're like, raising money from other people, right? You always want to have like the most attractive opportunity. You always want to have the highest numbers, etc. But I think there comes a point professionally where your brand is worth more than each individual transaction. So it's always to under promise and over deliver. It's always to say fundamentally, we have a refi strategy and we have a sales strategy. At least for us, we do a lot of ground up construction in the Northeast. We're in the most densely populated state, 30 to 45 minutes from the largest metropolitan area in opportunity zones. All of those are buzzwords. Basically, what that means is we invest in a very nice area. So for us, it's all to say, yeah, at that first refinance event, you'll make all your money back. Yeah, the projection is we'll accomplish in 3 years what a normal fund in real estate does in 10 years, because we don't do value add, we do ground up construction. So we're creating a lot more value. But fundamentally, if all of that doesn't work out and we sell, you still have a massive upside because you bought in before the land was rezoned. We've done over 400 rezonings. We've built well over 2,000 units. So we know what we're doing. But for that average investor who might be like a new investor, never invested in real estate, it's to say fundamentally, when you look at real estate over the past 5 years, 10 years, 20 years, what's happened to the price? It's gone up. Okay. You might not know this, but rent data basically is maybe twice in the history of the US has gone down. Maybe. It's either stagnant or gone up. When you look at inflation and how much money the US has printed, your dollar can buy less today than it could 5 years ago. So your rent is probably more than it was 5 years ago. When you look at tariffs, if we get our lumber, for example, from Canada, hypothetically, and now there's going to be tariffs, will it impact lumber? Time will tell. If we want to go down that rabbit hole, things will get more expensive. The cost of construction will rise. Your expenses get higher. You need to charge more. If you're charging more, the idea is you're charging more so that you make more profit, not so that you break even. And so fundamentally, Jeremy, to kind of summarize, your question, I would just say that people who get into real estate typically are quite analytical. They want to look at something and understand what the flow could look like. They want to look at past data and they want to project what the future could look like while recognizing that it's a projection and it can be wrong. But what is the safest asset class to invest in is typically what people are thinking. And then they go to real estate. And then when they realize, hey, you can make money in a tax efficient manner, hey, you can leverage, hey, you can do all of these other things to reduce your risk, to make this asset class arguably the best asset class to invest in, why would I not do that? Then when you realize it's not Wall Street, it's Main Street, I can buy things below appraised value. I can structure, strategic opportunities where I can be a doctor, I can be a dentist, I can be a business owner, and I can be making money in one area of life. And I can partner with a best-in-class person like Jeremy or Mustafa, and I can leverage their experience to invest in real estate. Now I created a passive real estate empire for myself, leveraging their skill set. You can't do that with your financial advisor, in my humble opinion. Or at least I haven't met that one financial advisor or those few financial advisors who are best in class. I think it's harder to find them than it is to find the best in class real estate investor, if that makes sense, Jeremy.
It totally does. And Mustafa, I really appreciate you kind of, summarizing and also, letting our listening audience know as a reminder what some of those benefits are in investing passively into real estate, versus just deploying all your capital, in Wall Street. Mustafa, what would be maybe one or two different ways that our listening audience can connect with you to learn more about what you're up to?
Yeah, I think the best way would probably be LinkedIn. So what we'll do is we'll have the LinkedIn link, in the show notes. Connect with me. Feel free to ask any questions, any way I can add value for you. Because ultimately, that's the goal. That's why I'm on the podcast. That's why Jeremy runs the podcast. It's just to add value for you guys.
Yeah, absolutely. Mustafa, thank you for providing our listening audience with value today. And listeners, thank you again for jumping into another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.